This is not going to be an easy transition. I know they want you to think that nothing's happening. I mean, we're just, it's just business as usual. Lots of things are happening. And I'm showing you a little bit under the surface to what really threatens the entire global system. We have been totally sold a bill of goods that debts and deficits don't matter. And, you can look at it with the ever expanding and exploding upward stock market that it kind of seems like that was true, and they don't matter until they do. And now it looks like it is beginning to matter in a very big way. And this is really significant for you and me because it signals the end of the system. This stuff is created from debt. So as long as debts don't matter and everybody's buying the debt and doing all that stuff, rock and roll hoochie coo, except that things have changed. And there was a systemic change in the bond market back in 22 when the Federal Reserve started raising rates, and then the global central bankers did too. This is a global issue. Let me show you what I'm talking about. Because here, Jamie Dimon warns of cracks in the bond market. That's what supports everything. The bond market is bigger than the stock market. I think the only market that's actually bigger than the bond market, and we're never going to know this until it's too late anyway, are the derivative markets that just take an itty bitty piece of equity and just build lots and lots and lots of debt on it. So let's look at what's happening on a global basis in these bond markets, because global debt fears rise as the U.S., Japan, and the UK face market scrutiny. But it isn't just the three of those countries that we're talking about. This is happening on a global basis. But the fact that they're questioning the debt of the U.S., Japan, and the UK is a pretty significant tell. And what that's telling you is we've got some huge problems on a global basis. That's what the interest rates are telling us as well. Look at this graph on the global gauge of long-dated yields at the highest since 2000 and, what year was that? 8. So remember, here's my bond example. These are interest rates. This is the market value. This is when they're issued. So the further out on this chopstick we go, the longer dated the bonds are, right? So you can see on this graph from 22, when they raised the rates dramatically, right? Look at what happened to the principal, the market value of the bond. It's in the toilet. This is why all of the banks are insolvent, and one of the reasons why they want rates to be dropped. They want the Federal Reserve to drop the rates because that debt has to roll over. But you can see that the longer the duration, the larger the fluctuation in the market value as interest rates move. It's critically important that you understand this piece. So I suggest very strongly that you give us a call, talk to your strategy specialist. They will have the time to walk you through it until you actually understand it. Education is key, because how many times can you be lied to when you do not know the truth? We want you to know the truth so that you can actually make good choices that put your best interest first. And in all of this increased yield, we've got an awful lot of volatility. So what does the volatility indicate? Why does it even matter? Because the volatility is an indication of how liquid the bonds are. In other words, how easy is it to buy and sell them in blocks without moving the price? And what this graph is showing you is that it is not easy to do that at all. But that's not something that suddenly manifested. That's something that we first saw back in 2015, where there was lack of liquidity in the U.S. Treasury market. That liquidity has not gotten better. It's only gotten worse. And when you look at this volatility chart, That's really what that's telling you. And this compares the 10-year, which is also spiking. But again, it just shows you that the longer the dates, the more the price action. The price action moving like this tells you that it is not easy to liquidate large blocks of those 30-year bonds. And I don't care whether that's the US or the UK or Japan or Spain or anywhere. The markets are now scrutinizing the debts and the deficits. So I think they're beginning to matter again. And how that impacts it is in the yield, right? So you've got the interest rate or the coupon rate when the bond is first issued coupon rate, right? But all bonds must always be sold at market. What determines what that price is? The yield, the effective yield. The coupon might be 5%, let's just say, but if interest rates are at 8%, you're going to buy that bond at a discount, right? The other way is true too. If the yield goes to 4%, you're going to have to pay a premium because the bonds will always be at market. The reason why this is a potential huge problem is because of bank runs. When they're sitting on all of this debt that is way underwater, meaning the banks are sitting on all of this debt, including the central banks, by the way, that is way underwater away from what they paid for it. What if they're forced to sell them? That means that price goes down even more, which means they're going to have to sell more, right? So it's a doom loop. We talk about the doom loop. This impacts this, which then impacts this, which then impacts this, and on and on and on. And the biggest problem is with the Treasury, the U.S. 10-year Treasury, because that is the foundation of the global markets. What a flipping concept. Look, since the great financial crisis, so since 2008, a lot of the regulations that were put in place created restrictions for the banks in buying government bonds because then they were required to hold some reserves, which we are in a zero reserve requirement right now, but that's mostly for your deposits, not for bonds. I'm sorry, I digress a little bit, but it's important that you understand that anyway. So when the banks pulled away from the government bond market, and the banks and governments as well, those are long-term holders. What stepped in were money managers, institutional investors, which are more short-term, right? So here, that was okay for a minute, but what we're seeing is a big shift in that. So that big money managers, they're using double line and PIMCO, stay away from beating up U.S. 30-year bonds. That makes that market even less liquid. Are you holding any? Are you holding any in your pension plan, in your 401k, in your IRA, in your regular brokerage account? Do you know whether or not you're holding them? Because if you're sitting in mutual funds or ETFs or those kinds of things, or even insurance contracts, right? Fixed term contracts, etc. Well, you might want to take a look underneath the hood and see if you aren't really being impacted by this, because somebody's got to buy those bonds or it's a bigger problem for governments. And we're looking at a 30-year Treasury yield that has catapulted higher. Doesn't this look pretty much like that other chart that I showed you on the global bonds? So this is happening everywhere, not just in the U.S. This is a huge crack in this very important system, because this debt is what creates this. So if they can't create that, they can't create this. That means that liquidity is even worse. And here's the thing. Stocks, bonds, ETFs, mutual funds, annuities, those are all created from this. And you can only convert them into this. So that has an area in one place, the financial system. That's it. But gold and silver, it's used in every single sector of the global economy. has the greatest functionality and the greatest demand. So if you haven't put your sound money strategy in place, I urge you to get it done, because what I just showed you today is the tip of the iceberg that you can't see. But this could trigger a route that easily could take the system down. And keep in mind, they need a very big crisis in order to make this transition. Are they ready yet? I don't know. Maybe. It's still going to take a minute. And even with the new iteration, will that mean that this problem is over? Not even marginally close. This is not going to be an easy transition. I know they want you to think that nothing's happening. I mean, we're just, it's just business as usual. Lots of things are happening. And I'm showing you a little bit under the surface to what really threatens the entire global system. So I want you to make sure that you are as independent and self-sufficient as possible. You need to secure food, water, energy, security itself, barterability, wealth preservation, community, and shelter. Arguably, community is the single most important thing, because we no longer have the luxury of time that I've had, because I started working on my urban farm after 2008 when I saw that the system died. I wasn't wrong then. I wish I was, but I'm not wrong now. And why not do something? What if you're right and what if you're wrong? It doesn't matter if you're holding physical silver and physical gold in your possession. But I am just one person. So there's only a limited amount that I can do. But together as a community, you and me and all of us, I think we can move mountains. Let's get sound money, redeemable sound money, back in the system again. And until next we meet, please be safe out there. Bye-bye.